Welcome back to the Deep Dive. This is where we take all that dense source material flying around, cut through the noise, and really try to pull out the insights you actually need.
That's the goal.
And today, well, we're looking at something genuinely puzzling, a real disconnect that's popped up this quarter.
It really is a fascinating tension. We've been digging into the latest data, specifically the JOLTS report, the one that measures U.S. labor demand.
Right, the job openings data.
Exactly. And we're putting that right alongside what's been happening in the precious metals market, especially with gold.
And the picture just doesn't quite add up, does it? The way history tells us it should, anyway.
Not at all.
So our deep dive today really zeroes in on this paradox. On one hand, you've got the U.S. labor market showing, well, pretty clear signs it's stabilizing.
Yeah, suggesting the economy might actually be pulling off that soft landing everyone's hoping for.
But then you look at gold. And the price is still powering ahead, isn't it? It's staying firmly above a really key level.
That's the core of it. If the economy's finding its footing, you'd normally expect people to feel less need for safe havens like gold. Risk goes down, gold should pull back.
But it hasn't.
It hasn't, and that's not just a little odd. It suggests something deeper might be shifting in what the market actually cares about right now.
Absolutely. So that's what we're going to unpack.
All right.
Why is gold seemingly ignoring potentially good news on the jobs front? We'll get into the specific JOLTS numbers, look at why gold holding above $3,800 is so significant.
And try to figure out what underlying factors, maybe what kind of structural concerns are keeping that gold price elevated, regardless of U.S. job openings.
Okay, so let's start with the U.S. economy side of things.
Yeah.
The JOLTS report Job Openings and Labor Turnover Survey. For anyone not glued to Department of Labor releases, remind us why this report is such a big deal, maybe even more revealing than just the unemployment rate sometimes.
Well, JOLTS is critical because it tracks labor demand. The unemployment rate tells you about labor supply, how many people are looking for jobs. JOLTS gives you the other side. It shows the number of open positions, hires, people leaving jobs, people quitting. It tells you how much appetite employers have for workers.
And that demand, that's a key inflation indicator, isn't it? And something the Fed watches like a hawk.
Precisely. High job openings relative to job seekers means employers have to compete for workers, often by raising wages. That fuels inflation.
So the Fed needs to see that demand cool off.
Exactly. Their whole strategy hinges on cooling labor demand without crashing the economy. They need fewer job openings to ease that wage pressure. So, JOLTS tells them if their interest rate hikes are working, if they're slowing down hiring, it's a key piece of that soft landing puzzle.
Got it. Now, the August numbers we just got, they didn't happen in a vacuum. There was a specific context leading into this report, right? What happened in July?
Yeah, the context is really important here. For a long time, late 2022, early 2023, job openings were incredibly high. We're talking 10, 11 million sometimes.
Way too hot for the Fed.
Way too hot. So the Fed was working hard to bring that down, and we saw a gradual cooling. But then in July, the month right before this August report, there was a sharp drop in job openings.
Ah, okay, so that sharp drop kind of set the stage.
It did. It looked like the Fed's policy was really starting to bite hard. It was the kind of move the market, and probably the Fed wanted to see.
Which means going into the August data release, the expectation was probably for more of the same, right? Continued cooling.
That was the general consensus, yes. Economists were mostly forecasting another dip, maybe down to around 7.19 million job openings for August. The market was kind of braced for more evidence that labor demand was softening significantly.
But that's not quite what happened. The headline number for August actually went the other way slightly.
That's right. The official number came in showing job openings actually rose a little bit to 7.23 million in August.
Okay, so 7.23 million versus 7.21 million in July. That's only, what, 20,000 jobs? Seems tiny.
On the surface, yes, 20,000 isn't a huge number in the grand scheme of the U.S. labor market. But remember that sharp drop in July.
Right.
Coming after that steep fall, even a small tick-up changes the narrative. It breaks the trend of sharp cooling. It suggests stabilization.
Okay, let me push on that a bit, though. Consensus was 7.19 million. We got 7.23 million. That's a beat of 40,000. Is that really enough to call it stabilization? Couldn't it just be statistical noise or, I don't know, revision somewhere else?
That's a fair point, and it really gets to how markets interpret data. Numerically, 40,000 isn't massive, but directionally it matters. The expectation was down, the reality was up, even if only slightly.
So the momentum changed.
Exactly. The pace of slowing was broken. Instead of continuing that sharp decline we saw in July, labor demand basically held its ground around that 7.2 million mark. It suggests maybe the labor market absorbed that previous shock and found a temporary floor.
Okay, so the interpretation shifts. It's not cooling fast anymore. It's more like holding steady, maybe even showing a bit more resilience than people thought.
Precisely. And you can see hints of this if you dig deeper into the JOLTS report, too, beyond just the openings number. You look at things like the hires rate that stayed pretty steady.
And what about the quits rate? That's always an interesting one.
Right. The quits rate, the percentage of people voluntarily leaving their jobs. High quits usually means workers are confident they can find something better, which points to a tight market and potential wage pressure.
So what did that do?
Well, the quits rate has generally been trending down from its highs, which is good news for the Fed. But the fact that total openings held firm above 7.2 million, even with quits moderating, it still signals that underlying demand and maybe worker confidence haven't completely collapsed. It's still perhaps a bit stronger than the Fed might ideally want for getting inflation all the way back to target.
Okay, that's really helpful context. So summing up the labor market picture, JOLTS suggests things have stabilized, not necessarily re-accelerating, but definitely not falling off a cliff. Resilience is the word.
Resilience, stabilization, yes.
Now, traditionally, what does that kind of news mean for a safe haven asset like gold?
The standard playbook says, bad news for gold. If the labor market is stable, if the economy looks resilient, the perceived risk goes down. The soft landing story looks more likely.
Less need for insurance.
Exactly. The urgent need to hold gold as a hedge against economic chaos or a deep recession diminishes. Logically, you'd expect selling pressure on gold, maybe a price correction downwards.
But that's not what we saw. Not at all. It seems logic took a vacation where gold is concerned. Which brings us neatly to our second section, gold's stubborn strength. We've got this picture of a stabilizing U.S. economy, yet gold prices.
Well, they're not just stable. Our sources say they're firmly on an upward trajectory.
Yes, and the real sign of that underlying strength is the price holding consistently above $3,800 an ounce. That's not just a number. It's become a really critical line in the sand.
A threshold. Why 3,800? What makes that level so special? Is it just a big round number people focus on, or is there something more technical? It's actually a bit of both, which makes it quite powerful. Psychologically, breaking through and then holding above a major round number like 3,800, it builds confidence, confirms momentum for traders.
Sure.
But technically, analysts see it as a level where significant institutional money likely stepped in. Think central banks, large investment funds. As gold pushed through previous resistance levels, it probably triggered buy orders in that, say, 350 to 3,800 zone.
So their cost basis might be around there.
Potentially, yes. Or at least it's a level they're now committed to defending to protect those positions and validate the next leg of the rally. Seeing the price hold above 3,800 suggests those deep pockets are actively supporting it. It signals conviction, not just short-term bets.
Right, long-term conviction holding the line. That makes sense. But it hasn't been a smooth ride up there, has it?
Yeah.
Our sources mentioned overnight volatility. What does that tell us?
That volatility, yeah, it shows there's still a bit of a tussle going on. It's the short-term traders reacting to quick moves versus those longer-term holders. The data pointed to gold hitting a pretty sharp overnight high, didn't it? Around $3,870 an ounce.
$3,870, yeah. That's a significant jump.
A very rapid move. And what happens when you get a fast headline-grabbing spike like that?
People take profits quickly.
Immediately. It's almost reflexive market behavior. Traders who maybe bought in when it was consolidating lower, perhaps around 38.20, they see a quick $50 pop.
They cash in. Makes sense for them.
Absolutely. It's rational profit taking for anyone operating on a shorter time frame. Lock in the gain before any natural pullback happens.
And that selling pressure is what creates that volatility, pushes the price back down a bit from the peak. So 38.70 acted like a temporary ceiling.
Exactly. So you see that tension playing out. You've got the long-term, maybe institutional support defining that 3,800 floor, but the short-term market gets skittish and quick to sell near those rapid highs like 38.70.
It's like one group is building the foundation, the other is just reacting to the day's weather.
That's a good way to put it. The long-term buyers are laying the groundwork, focused on that 3,800 support. The short-term traders are reacting to the quick gains, the sudden spikes, creating that surface noise around 38.70. but the underlying structure holds.
Okay, so here's the crux of it, connecting back to JOLTS. If traders are jumping to sell at 38.70, taking those quick profits, why didn't the price just keep falling? Especially when you had the JOLTS report suggesting the economy is stable, which should, in theory, weaken the case for gold. Why didn't it tumble back towards 3,700 or lower?
The very fact that it didn't collapse, that it absorbed that profit-taking and the supposedly negative news from JOLTS and still held firmly above 3,800, well, that tells you something really important.
Which is?
It tells you the underlying support is incredibly strong. It means the buyers defending that 3,800 level are basically unmoved by the nuances of the U.S. monthly jobs report. Their reasons for holding gold are bigger, much bigger, than whether job openings beat expectations by 40,000.
Their perspective is more structural, less cyclical.
Exactly right. Whatever forces initially pushed gold up past 3,800, and we need to talk about what those are, they're clearly still the dominant factors in the market right now. A slightly better than expected JOLTS report isn't enough to derail that thesis.
Okay, let's bring these two threads together now. We've got the labor market picture showing stabilization. We've got the gold market showing persistent strength above 3,800.
Yeah.
The main takeaway, the reason we're doing this deep dive, is that gold just didn't really react significantly to that JOLTS report.
Right, and it's the lack of reaction that's so telling. If gold's price was mainly being driven by traditional factors like, say, worries about imminent U.S. recession or expectations about the Fed's next move based on domestic data,
It should have gone down on that JOLTS news.
it absolutely should have. Lower perceived risk, maybe expectations of the Fed staying higher for longer because the economy's okay, both are typically gold negative. The fact that it didn't meaningfully decline signals a potential decoupling.
Okay, so let's talk about that decoupling. The good news paradox, as you called it earlier. Good news on jobs should hurt gold, but it didn't. This suggests investors are prioritizing other things entirely. What are those other things? What's this structural fear you mentioned?
When we talk structural, we mean risks that are bigger and longer term than just the monthly U.S. economic cycle. Risks that could affect the whole global financial system. Looking at the source material and just market chatter generally, two big ones stand out right now, and they seem to be outweighing JOLTS.
Okay, let's break them down. What's the first major driver?
First is sovereign debt risk, particularly focused on the U.S., but it's a global issue too. The sheer amount of government debt and ongoing deficits, well, it's staggering.
Hard to ignore the numbers.
It is. And large institutions, central banks around the world, they look at those long-term debt-to-GDP trajectories and worry about the future value of fiat currencies, including the dollar. How can all this debt be managed without devaluing the currency over time?
Through inflation or just printing more money, essentially?
Right. And in that scenario, gold, which has no counterparty risk, no government liability attached to it, becomes very attractive as a store of value. A positive JOLTS report. Fine, it means the U.S. economy is strong enough today to keep borrowing. It doesn't solve the underlying debt mountain.
That's a crucial difference. JOLTS is a snapshot of today's health. The debt is a long-term structural issue. Okay, what's the second big driver keeping gold elevated?
The second one, and this feels particularly potent right now, is geopolitical systemic risk. There's just a lot of instability and tension globally.
I mean, beyond just isolated conflicts.
Yes, we're talking about shifts in global power dynamics, tensions between major trading blocs, questions about supply chains, the potential for broader conflicts, the ongoing discussions around de-dollarization.
The kind of uncertainty that makes people question the stability of the entire global financial order.
Exactly. When investors, or perhaps more importantly, central banks, start seriously worrying about those kinds of large-scale systemic risks, or even things like sanctions risk impacting their dollar holdings, they tend to move towards assets perceived as truly safe and universally accepted. And that's gold.
So if you're, say, a central bank manager looking at diversifying reserves away from the dollar because of geopolitical friction, or you're a large fund hedging against a major global shock,
the fact that U.S. job openings were 7.23 million instead of 7.19 million is, well, it's barely relevant, is it?
it's rounding error compared to the scale of those other concerns. It's a fundamental shift in what's driving the price. Gold used to be primarily a hedge against U.S. inflation or recession. Now it seems to be acting much more like a barometer of global systemic health and trust in the fiat system itself.
The ability of gold to just absorb that JOLTS report without flinching really underscores that point, doesn't it? It suggests those bigger fears, the debt, the geopolitics, are already deeply embedded in the price north of 3,800. It does. It suggests the market has priced in those risks, and that price level is supported by players who are looking far beyond the next U.S. jobs number.
Okay, let's just quickly recap the comparison for everyone listening. Two key pieces of data, two different stories.
On one side, you had JOLT tests, 7.23 million job openings, beating the 7.19 million expectation slightly. Signal. U.S. labor market is stabilizing, resilient. Good news, domestically speaking.
On the other side, you had gold. Brief volatility hitting 3,870, followed by profit-taking, but crucially, holding firm above the 3,800 support level. Signal. Underlying trend remains strongly upward, ignoring the JOLT test data.
And the synthesis is pretty clear. The stabilization in the U.S. labor market just wasn't powerful enough, wasn't relevant enough to knock gold off its course. The global structural factors are in the driver's seat.
And that has real implications for you, the listener, doesn't it? If the Fed's main tool for cooling inflation tightening the labor market isn't impacting demand for a key inflation hedge like gold,
it suggests the very nature of inflation fear might be evolving. Maybe it's less about domestic wage spirals now and more about global concerns, sovereign debt sustainability, geopolitical stability, trust in the system itself.
it feels like the market is basically saying, yeah, the U.S. might be managing a soft landing, that's nice, but look the rest of the world, look at the debt. We still need insurance.
That sums it up perfectly. And right now, gold is the preferred form of that insurance, regardless of a slightly sunnier patch in the U.S. jobs report.
Okay, let's wrap up this deep dive then. We've looked closely at the specific numbers that created this paradox. JOLT test job openings ticking up to 7.23 million.
Signaling that stabilization after the sharp July drop. Resilience in the U.S. labor market.
And simultaneously, gold showing real underlying strength. It shrugged off that spike to 3,870 and the profit-taking that followed, and most importantly, held that key $3,800 line. It just ignored the JOLT test news. So the big takeaway for you listening is this persistent decoupling. Gold's rally seems increasingly driven by these global, structural, long-term worries, debt, geopolitics, and they're currently overshadowing the traditional influence of domestic economic data, like job openings.
Which leads us to a final thought, something to mull over based on what we've seen here. We've established that a pretty solid sign of U.S. labor market stabilization wasn't enough to dent gold's momentum above 3,800.
Right, so the question becomes, if gold is now playing by these different global rules, what other traditional market relationships might start to break down? What other indicators that used to move inversely to gold might also decouple if this new regime holds?
Well, think about something like bond yields, maybe the 10-year Treasury yield. Historically, if the economy looks stable or strong, yields tend to rise as inflation expectations might pick up or the Fed is seen staying tight. And rising yields usually hurt gold because gold doesn't pay interest.
Right, the opportunity cost goes up.
Exactly. But what if we start seeing gold rallying even when Treasury yields are rising because of positive U.S. data? That would be another strong sign, wouldn't it?
It really would. It would further confirm that gold is trading less like a simple inflation recession hedge and more like, well, like a hedge against the fiat currency system itself, driven by those global debt and geopolitical factors.
Precisely.
So maybe the advice is, keep watching JOLTS, sure, but pay even closer attention to how gold reacts to news about sovereign debt, about global summits, about geopolitical flare-ups. If U.S. data keeps being ignored, you know the game has changed.
It's definitely something to keep a close eye on going forward. A really interesting dynamic.
It certainly is. Okay, that's our deep dive for today. Thanks for joining us as we unpack this puzzle of stabilization versus safe haven strength. We'll catch you next time for another look beneath the surface.